These are tough times for marketers, but you're not powerless. There are things you can do. We certainly have been through some tough times in the last 3 years. One might say that the whole of our world has been turned upside down. The combined effect of these factors, the mismatches between supply and demand, the tightness of labour markets, and the energy shock, has been a rise in inflation, the biggest rise in inflation for over 40 years. And as central banks try and cope with that rising inflation, we're seeing a rise in interest rates, the biggest rise in interest rates for over 30 years. All around the globe, marketers are asking, is it time to cut advertising costs? Now, there's no simple answer to that. In order to know whether you should cut and how much you should cut and what you should cut, you need to think about advertising not just as a cost, but as an investment. We've always argued that advertising is an investment, not a cost, and I mean that in a really hard financial sense. Think about how advertising benefits companies. Advertising is a cost in the short term, but it's a way of generating extra sales and profit in the short, medium, and long term. So just like any other financial investment, you're talking about putting money in now and getting a flow of incremental profits over the next few months and years. And accountants and economists know exactly how to calculate and optimize financial investments using something called shareholder value theory. You don't need to know the precise mathematics of it, but basically what you're trying to do is to maximize what's called shareholder value. That's the net present value of that flow of incremental profits minus your initial investment cost. So there is a formula for that. There's a button in Excel that can do that for you. But what you need to understand is what that flow of incremental profits is and what are the factors that affect it. As far as advertising investment is concerned, there are 5 factors that determine how much you should invest, when you should invest it, and the balance between short and long term. I call these the 5 keys to optimal advertising investment. The first is to understand the growth prospects for your company and your brand over the next few months and years. The second is to understand what your profit margins will be. The third is to understand what those advertising costs are and how they might change. The fourth is to understand capital costs and in particular the risk premium that you pay. And finally, you need to think about advertising effectiveness and efficiency. And in these videos, I'd like to talk about each of those 5 factors in turn. When you're thinking about how much to invest in advertising or other marketing communications, one of the things that you need to take into account is how much your brand or your company is going to grow over the next few years. When growth is rapid and strong, the case for investment is easy. But if your brand is static or declining, it becomes much harder to justify investment in advertising or other marketing. So what can we expect in terms of growth over the next year or so? Well, those of you who lived through COVID and before that the global financial crisis will know how severe recessions can be. Back in 2020, we saw an 11% contraction in GDP, the sharpest, deepest recession in the UK for over 300 years. And back in 2009, we saw a contraction of 4.5%, also pretty severe. But those were exceptional. If we go back into the 70s, the 80s and 90s, then the kind of contraction in GDP that we see for a normal recession, if there is such a thing, is usually much milder. And in fact, the Bank of England is forecasting that GDP will probably grow slightly this year overall, even if we do get 1 or 2 quarters of contraction. Now think about what happens to consumer spending during a recession. Again, the last 2 recessions saw really severe reductions in consumer spending. During COVID, total consumer spending in the UK fell by 12.5%. That's the combined effect of recession and lockdown. Things were pretty bad during the global financial crisis as well, a contraction of 2.5%. But again, those last 2 recessions were exceptional. These occurred during periods of very low inflation. We now have inflation of around about 10%, the highest rate for about 40 years. So when thinking about what's going to happen to top-line revenues, it's much more realistic to look at what happened during high inflation recessions, like the 70s, the 80s, and the 90s. And the good news is, during all of those recessions, consumer spending actually grew in top-line nominal terms. So when you're thinking about a relatively mild recession coming up in the UK with relatively high inflation, most firms can expect to see consumer spending and top-line revenue growing this year. And then, of course, some sectors will do better than others. Let's look at how share of consumer spending changes during a recession. What we find is that some sectors do worse than the average, and so their share of consumer spending will fall. So that's things like transport, restaurants and hotels, tourism, recreation, culture. All the discretionary spending, all the treats and the luxuries and the days out and the holidays. Unfortunately, those sectors tend to do badly when times are tough. Then there's a bunch of stuff that more or less jogs along as normal. For example, clothing sometimes does a little bit worse than average, sometimes does a little bit better. Same with health. Same with household equipment, durables and so forth. Sometimes a little worse than normal, sometimes a little better. And there are some sectors which tend to do well, relatively well, in a recession. These are more the necessities and the very basic goods and the small treats, if you like. So communication, education, basic things like basic food and drink, alcohol, tobacco. Narcotics do quite well in a recession, I'm told. I'm not quite sure how the government measures that. And obviously basic bills like housing, the mortgage, water bills and energy bills and so on. They tend to do better than average during a recession. So what am I expecting this year? I think durables might have a tough time since we've had such a splurge on durables in the last couple of years. People have bought those bicycles and coffee machines. But one area where I think sales will hold up well is FMCG. I think we can expect FMCG revenues to grow this year and probably be one of the brighter spots of the economy. So if you're a packaged goods brand, as we'll see later on, this might be a time when you might considering investing at even a higher rate than normal. Finally, I'd like to point out that within each sector, some people do better than others during a recession. Younger people are going to be suffering quite a lot over the next year or so. Energy bills are going through the roof. Mortgage rates are rising, rents are rising. So younger and poorer families are going to be suffering more than most because those are bigger components of their household bills. Conversely, older and more affluent households are much less affected by things like mortgage rates, rents and so on. In fact, some older consumers will actually be thriving right now because they are getting more income from their savings and the interest rates on those savings. So this might be a point at which you might consider switching your focus from younger households to those empty nesters who will be relatively unaffected. And of course, that has implications for media, since younger consumers tend to consume more of the newer digital media, and those older, more affluent households are still big viewers of TV. So you might want to consider tilting some of your media back towards some of the more traditional media like TV.